Hi, I'm Bob, the Mortgage Coach Mitchell, and we are going to do a content video again today. This is going to be on assumable mortgages. With the interest rates being up and a lot higher than what they have been here recently, one of the things that people might want to consider, especially if they have a little bit of money to work with, is to look into buying a home that has an assumable mortgage on it. Now, what is an assumable mortgage? Basically, that is a mortgage that, in its terms, in the agreement that the original borrower and the original lender made, there is an assumption clause that gives the borrower the right for somebody else to assume that mortgage. Now, back in the day, it was a better deal because you didn't have to income qualify or employment qualify or anything like that. Those days are gone. So the thing is, now you still have to pretty much qualify for the mortgage. So, just if you have bad credit or recent bankruptcy or anything, it's not a trick to get around that. It's just going to be the if your income ratios are in line, if you're sometimes you have to put at least a certain amount into it. That's not going to be an issue because that's one of the biggest issues with doing assumable is how much money it costs. But there is a minimum on FHA. You still have to put 3.5% into the deal, even if you're assuming the mortgage. But most of the time, the mortgage balance is going to be considerably less than the sales price. And in order to assume that mortgage, you as the borrower or the assumptee needs to go ahead and bring that money into the table to make up the difference. So, for example, if the house is selling for 200,000 and the mortgage balance is 150,000, then you as the buyer who wants to assume that mortgage is going to need to be able to come up with the $50,000. That's the equity position. That's the difference between the loan balance and the sales price of what you're buying for the house. There are also some closing costs, but generally they're a lot less expensive than originating a new mortgage. So, but the biggest advantage of assuming a mortgage is that you can get a below market interest rate. For example, if somebody bought the house back at the very bottom of the market, they might have a 2.75% interest rate that still has 27 or 26 years to go on it. So when you assume it, you assume the rest of the term of the mortgage. It's not starting over at 30. If the people have had the mortgage and they've made 7 years of payments, then you're assuming the remaining 23 years of that loan. So that's actually kind of good because that means that the amount that's going towards your principal is probably going to be higher. It's similar to taking a shorter term like a 15-year amortization. But again, you're going to have to basically come up with the difference in the payment, and you're going to be assuming the terms and the remaining balance of the loan as long as the remaining repayment period. The advantages of assuming a loan is you're going to have fewer closing costs, not necessarily zero, but a lot less generally, because you're not going to have to pay for an appraisal, and that could be $600-800 right there. The biggest one, again, is the lower interest rate than what is currently available. Right now, you're talking 7.25%, 7.5%, depending on what kind of program you're in. And if you can assume a loan that's a 4%, you're way ahead of the game right there. So now the types of loans that are out there that can be assumed are FHA mortgages. Again, FHA requires that you credit qualify. So you're going to have to, have at least halfway decent credit. Now, FHA can be fairly lenient, but they're not going to give up a really good borrower to go with a so-so borrower. So it's, you got to look at it and make sure. But you are going to have to qualify on both credit and income, the same as you would on a new house. Okay, USDA, kind of, sort of. They are assumable, but usually they want to recast the mortgage at the current interest rates and thing, and that does away with the biggest advantage of assuming a mortgage. So that's not necessarily going to be the best deal. VA, Veterans Administration loans, they are indeed assumable. Again, you have to credit qualify, but you don't have to be a veteran in order to qualify for that mortgage. So look at the VA loans out there. Generally speaking, if it has a conventional mortgage on it, it's not going to be assumable. There are a few non-conforming loans out there that have a mortgage assumption clause in it, but they're very few and far between. So basically, it's going to have to be an FHA, a VA, or kind of sort of a USDA. Okay, again, USDA is FHA's dysfunctional country cousin, so you know that they're going to do things strange. Anyway, how to assume a loan. Okay, basically, you're going to have to come up with the difference between the sales price and the loan balance, okay, as well as possibly a little bit of closing cost. Um, you're going to need to contact the current lender and see what their procedure is. It varies lender to lender. Some of them are real easy, real quick. Other ones are, it's not a whole bunch different than applying for a new mortgage. They're going to have you provide 30 days worth of paycheck stubs, W-2s, bank statements, the whole rigmarole. Other ones basically just pull a credit report on you and maybe verify your income. Then they call it a day. So anyway, it varies lender to lender. So if there's a house that you're interested in that has an FHA or a VA that's at a lower interest rate, then you definitely want to reach out to the lender and find out what their procedures are. Okay. Inheriting a property, that's one way. That one can be unconventional. So if you inherit a property, and you don't have to be a relative either, that's another one that people think too, that you have to be a relative even if you've inherited the property. If you inherited the property and it has a mortgage against it, generally speaking, you can just continue making the payments on it. And you can assume that mortgage. You do need to contact the lender and let them know that you're going to be the ones making the payment. You'll need to probably provide documentations like copies of the will or the trust or the estate or whatever. But you know, again, if you inherit a property, it might be something to consider as opposed to you know having to go out and get a new mortgage for it with all the expense that goes with that. So anyway, that's basically what goes into assuming a mortgage. If you have any questions about it, it can be a very, very good deal. It can be kind of expensive to get into, but if you're selling one house and say you're at a 3.5% interest rate on that house and you have a pretty good equity position, you can go out and buy a nicer house, okay, and assume the mortgage on it. And if you're getting a lump sum out of your old house, put that down on the new one and get to 2.5, 3% on the new mortgage. Now, again, you're going to have a shorter amortization time, which can be a good or a bad thing. Anyway, if you have any questions about assuming mortgage, I'm Bob, the Mortgage Coach Mitchell. Now, let's put you into the house either with a new mortgage or if you assume it. Bye bye.